I didn't say it was going to go down hard. I just think it's overvalued. My work is driven by a 155 variable computer model that took me 5 years to develop back in the 1990s. And when I run the S&P 500 names through my computer right now, only less than 10% of them are coming up as catching my interest at all. You only have 20% of the names in the S&P 500 right now trading at less than 13 times speculative estimates for next year, and half of those 100 names are value traps. So people that look at value as I do, we only have a few dozen names to even consider right now.
But you don't think we're going back to test the February lows?
Oh, yeah, I think we could test the February lows and the lows.
Well, I said at the top, you think the market's going to go down and go down hard. That's not going down hard? You're going to go back to February?
No, I thought you were talking about like 20% or more. I think we could test 16,000.
Oh, God, let's hope not.
I think we could test 16,000 on the Dow Jones again. I wouldn't bet on it going below there, but it wouldn't surprise me if we go to 15,000, which would be below the lows we saw recently.
Who wants to take issue?
I love this kind of pessimism. I mean, you know, the issue here is we know there's lots of anecdotal evidence that domestic companies are having a pretty good run. What you're talking about, the S&P 500, 47% of their revenue comes from outside of our jurisdiction. That's what you're complaining about because the headwinds are not with them. The dollar will go up if the Fed raises 25 or 50 bips. There's no question they'll hit that headwind. But that doesn't mean you can't find domestic names trading at well below market PEs that are selling domestically in an economy that is growing somewhere around 1.5% to 2%. That's where you've got to rest your dollars right now, unless you want to exit the market, sit in cash, and make nothing. Thank goodness I'm here. You know that.
I look at the valuation, and as a value player, 90% of the names in the S&P 500 will not even get consideration from me right now.
Well, you hate financials for sure then, right?
Well, by default, you're forced into sectors as a value player. You're forced into financials, industrials, tech, and healthcare names that are trading at 8, 9, 10, 11 times earnings.
But those are value traps.
Some of them are, but I'm not going to pay 18 times earnings
I agree with
for
you.
staples names that have 3% revenue growth, which is where people are hiding right now. You have zero upside there, and the only reason to go into these names is because there may be less downside risk in those names if the market goes down. That's not a reason to invest.
It's a good point to sort of turn the conversation in that direction, in that these places where investors have been going, utilities, staples, telecoms, bond proxies where you're getting yield, if the Fed does raise rates, don't they become less attractive?
Correct.
Kevin O'Leary?
Well, the utilities right after the February swoon, when they were looking good as a safe haven, have turned around and been bad performers because of the concerns on rate hikes. Traditionally, people look for safety and yield in telcos, utilities, and REITs. That will be a bad outcome. I totally agree with that. But you don't have to invest there when you know or you think with certainty you're going to have a 50 BIP, maybe 75 BIP raise between now and the next 10 months. I think that sector will be flat to down and be worth revisiting after the Fed is finished. I don't know when that's going to be.
But where do you want to go then? If you want to get out of these spaces, and then the other ones that we talked about are perceived value traps.
Well, no, we're talking about them being overvalued. You don't like a 17 PE, right?
Yeah, and another thing that I rarely hear anyone speak about on Wall Street, I run 2,000 names through my computer model every week, and only 100 of them are in the telecom sector, 100 in the materials sector, 100 in utilities. Most of the other sectors, you have 200, 300, 400 names to choose from. So if you're looking to put money into a defensive sector like utilities or telecom, there's only a few dozen quality names in each of those two sectors. And what happens is when you have the portfolio managers looking for a place to hide, they're all rushing into these few dozen names and they become overvalued. And that's why they really look attractive.
Let me ask you a question.
Players.
Your thesis is that PEs will compress because if you take very stable companies that are going to have flat earnings and flat sales, because that's what the earnings are telling us right now. Let's say the market just stays where it is. You can garner a 2.8 to 2.9% yield off that now, just sitting in them, just waiting. And you're saying you can't do that because you'd rather be in cash making nothing, or you think they're going to go down 20%. That's your thesis, right?
Well, first of all, let me just jump in there because the 2.9% yield can become a 3.5% yield pretty quickly.
I get it.
And it takes you a year to get that yield. So you're assuming you're going to sit there for a year and get that. I think that dividend investing, and you love it, and I love it too, but it's only one element, one factor in any stock. Take BHP, which you like. They cut their dividend by 90%.
Yeah.
So I sort of, lost more in the stock price than I'm ever going to make a dividend, at least in the near term.
I want to get to a name, but so you say you run all these names through these screens on your computer. Twitter came up to you as a buy.
Yes.
Why?
I was a little bit early trying to pick a bottom on it. When it dropped 75% off of its high, I decided to take a shot at it. In my opinion, the market is very good at downgrading names after bad news comes out, and upgrading names after good news comes out. I do the opposite.
A little late to the party, in other words?
They're always late.
But why does price define value? Why does price define value? The fact that it came down 75% means nothing. When Valiant got cut in half by 50%, you still would have gotten your lungs ripped out if you bought it. So where do you see the value in Twitter?
I rarely, if ever, recommend names that are trading at more than 10, 12, 14 times earnings. I made an exception with Twitter. It's trading at 22 times earnings, but they have $3.6 billion in cash. The market cap is only $10 billion. I don't think Facebook should be trading at 33 times the valuation of Twitter. The market is very good at reacting to the most recent press release that
So Apple
Twitter
must
put
be
out.
your biggest position then, right?
I actually was on CNBC 2 years ago, and I blacklisted Apple on ethical and moral grounds, and that got a lot of attention. So I don't go near Apple.
And at that note, I want to talk about another
name. It does
name.
score number 1 out of 500 according to my computer model right
You'd
now.
rather buy Twitter today than J&J?
I would never go near J&J with a 10-foot pole. Twitter, you know what the problem is?
That's why there's a market, my friend.
The problem is with Twitter that no one on Wall Street is assigning any sort of probability to a positive headline coming out of there.
But Twitter is a speculation. It hasn't returned any capital to shareholders since inception.
The company is trading at 23 times earnings. I'm expecting 20% EPS and revenue growth next year, and they have $3.6 billion in cash.
It's radioactive waste. That thing is dangerous.